A $4.6 billion disappeared in just a few weeks. The man who lost it wasn't reckless or careless. He was a Nobel Prize winner, honored for his work on understanding how financial markets function. At the same time, another man, living a few states away, was quietly becoming one of the richest people in history. He bought ordinary businesses, ignored daily headlines, and, by his own admission, spent plenty of time taking naps. Same markets, same period. One nearly helped bring down the global financial system. The other built one of the greatest fortunes ever. This isn't a story about intelligence. The smartest people in the room can still lose everything. It's about the 12 investing mistakes that repeatedly destroy wealth, generation after generation. They're the exact mistakes Warren Buffett has spent more than 60 years avoiding. My name is Isaac, and after studying why brilliant people often struggle with money, while Buffett keeps winning, I realized one thing ties every mistake together. They're all versions of the same problem. Trying to be smarter than the market instead of more patient than it. Buffett summed it up perfectly. The most important quality for an investor is temperament, not intellect. Keep that thought in mind because it explains everything that follows. To make this practical, we'll follow someone named Henry. Henry is 34, smart, follows financial news every morning, and genuinely wants to invest well. Yet, like most people, he slowly walks into nearly every mistake on this list. Not because he's unintelligent, because he's human. And in investing, being human can be expensive. Almost everyone has thought about doing it. I'll wait for the dip. I'll sell before the crash. I'll buy back when things feel safer. It sounds logical, but it depends on one impossible assumption that you can consistently predict the future. Buffett has little respect for market predictions. In his 1992 shareholder letter, he joked that the only value of stock forecasters is making fortune tellers look credible. Even during the 2008 financial crisis, Buffett openly admitted he had no idea where the market would be a month or a year later. Here's why trying to time the market is so costly. Markets don't rise steadily. A huge portion of long-term gains comes from only a handful of exceptional days. If you invested $10,000 for 20 years, it could grow to roughly $65,000. Miss just the 10 best trading days, and that falls to around $29,000. Even worse, many of those best days happen immediately after the worst ones. The moment investors panic and sell is often right before the recovery begins. People love pointing out the few investors who predicted major crashes. What they forget are all the times those same people got it wrong. Henry made this exact mistake in 2020. As markets crashed, he sold everything, planning to buy back once things settled down. By the time he felt comfortable again, the market had already recovered sharply, leaving him behind. Meanwhile, Buffett was buying. The lesson is simple. Time in the market beats timing the market. The investors who stay invested are usually the ones who benefit from the recovery. Some of the biggest investing costs are almost invisible. They're not large bills or obvious charges. They're small annual fees that quietly reduce your wealth year after year. Buffett warned that when trillions of dollars are managed by professionals charging high fees, it's usually the managers who become wealthy, not their clients. Consider this. Invest $100,000 for 30 years earning 7% annually. With no fees, you finish with roughly $760,000. A 1% annual fee reduces that to about $570,000. A 2% fee leaves you with only $430,000. That extra 2% quietly costs around $330,000 over time. Buffett didn't just talk about this. In 2007, he made a famous $1 million bet that a simple, low-cost S&P 500 index fund would outperform a collection of elite hedge funds over 10 years. The hedge funds had expert managers, advanced research, and sophisticated strategies. The index fund simply owned the market. After fees, the results weren't even close. The index fund gained roughly 125.8%, while the hedge funds averaged only 36.3%. The lesson wasn't that professionals are unintelligent. It was that high fees create a hurdle most managers simply can't overcome. A fee is guaranteed. Outperformance isn't. Most investing mistakes aren't caused by lack of knowledge. They're caused by emotion. Research consistently shows that highly active investors earn far less than the market itself. Why? Because they constantly react. They buy when excitement is high. They sell when fear takes over. Every trade creates another opportunity to make an emotional decision. It can also create trading costs and taxes that patient investors often avoid. Henry checks his investment account several times every day. Every market move feels urgent. He mistakes activity for progress. In reality, constant action usually reduces long-term returns. Successful investing often looks boring. That's because patience allows compounding to do the work. The more emotional your decisions become, the more expensive they usually are. And that's exactly where the next mistake begins. Here's a simple truth that catches a lot of investors. Using a company's product doesn't mean you understand its business. You might love a coffee shop, drive a particular car, or use a popular app every day. But that doesn't mean you understand how the company makes money, how much debt it carries, who its competitors are, or what could threaten its future. Warren Buffett built his career around what he calls the circle of competence. His philosophy is simple. You don't need to understand every business. You only need to recognize the few you truly understand and stay within those boundaries. As Buffett once wrote, the size of your circle isn't important. Knowing its boundaries is. He even followed this rule himself. For years, Buffett avoided technology companies because he believed they were outside his circle of competence. That discipline protected him from the dot-com crash. But it also meant he missed companies like Amazon and Google, something he has openly admitted. His point wasn't that avoiding every opportunity is smart. It was that losing an opportunity is far less damaging than losing money in something you never understood. Every few years, a new trend captures investors' attention. Crypto, artificial intelligence, biotech, whatever is making headlines. Many people invest simply because prices keep rising, not because they understand the business behind those prices. When excitement fades, they panic and sell because they never understood what they owned in the first place. Henry made the same mistake. He bought shares in a company because everyone called its CEO a visionary. He knew the stock symbol, he knew the headlines. But if someone asked how the business actually made money, he couldn't answer. That isn't investing, it's speculation. Humility means admitting what you don't know. Imagine buying a stock for 50D. A few months later, it falls to 30. Instead of asking whether it's still a good investment today, most people focus on one number, the price they originally paid. That number becomes emotionally important even though the market doesn't care what you paid. Henry decides the stock is now cheap and buys more. Then it drops to 20. He buys again. Then 10. Again he adds more. He believes he's getting better bargains each time. But if the business itself is getting worse, a lower price doesn't automatically create value. A bad company can become cheaper and still remain overpriced. Buffett's advice is incredibly simple. If you find yourself in a hole, stop digging. The important question isn't digging. How much am I down? It's, knowing everything I know today, would I buy this business right now? If the answer is no, then holding it simply because you already own it is letting pride make your decisions. The market has never heard of your purchase price. Neither should you. Buying something because everyone else is buying feels safe. That's exactly why it's dangerous. For thousands of years, following the crowd helped humans survive. In investing, it often leads people into bubbles and keeps them invested long after they should leave. Buffett often reminds investors that you're not right because everyone agrees with you. You're right only if your facts and reasoning are correct. During the dot-com boom, Buffett compared investors to Cinderella at the ball. Everyone knew the party would eventually end. Everyone planned to leave 1 minute before midnight. The problem was that nobody knew when midnight would arrive. Then the bubble burst. The Nasdaq eventually fell around 78%. Years later, history repeated itself with meme stocks. Many investors bought simply because online communities convinced each other prices would keep rising forever. A few people sold near the top. Most didn't. They watched their gains disappear because the crowd never tells you when it's time to leave. The lesson isn't to always do the opposite of everyone else. Sometimes the crowd is right. The real lesson is to think independently. Henry joined an online investing group. Everyone sounded confident. Everyone expected the stock to go to the moon. For a while, it did. Then it came back down just as quickly. Today, the group is mostly silent. Confidence from a crowd is never proof that something is a good investment. Often, it's the opposite. Now let's return to the story from the beginning. The patient investor was Warren Buffett. The brilliant investors who lost billions were Myron Scholes and Robert Merton. Both were Nobel Prize winners. They helped manage long-term capital management, one of the most sophisticated investment funds ever created. Their investment models were brilliant. Their biggest mistake wasn't intelligence. It was leverage. To increase returns, they borrowed enormous amounts of money. Their fund was leveraged roughly 25-to-1. That meant a relatively small loss could wipe out nearly all of their actual capital. When markets moved in ways their models didn't expect, the fund collapsed, losing around $4.6 billion. A Federal Reserve-backed rescue became necessary to prevent wider financial damage. Buffett later summarized the lesson perfectly. To make money they didn't have and didn't need, they risked what they did have and did need. Charlie Munger made the same point with his usual humor. There are only 3 ways a smart person can go broke: liquor, ladies, and leverage. Then he admitted he included the first 2 only because they started with the same letter. Leverage magnifies both gains and losses. Imagine investing 10,000 and borrowing another 10,000. You now control 20,000. If the market falls by a normal 25%, your investment becomes worth 15,000. But you still owe the borrowed 10,000. Your own money has been cut in half. A patient investor who didn't borrow simply waits for the recovery. A leveraged investor may be forced to sell at the worst possible time because of a margin call. Leverage removes your greatest advantage, the ability to wait. And in investing, patience is often the most valuable asset you have. Most investors know the price of every stock they own. Very few know what those businesses are actually worth. Buffett has explained the difference in one famous sentence: price is what you pay, value is what you get. The price is simply the number displayed on your screen today. It changes every second based on emotions, headlines, fear, optimism, and speculation. Value is something completely different. It's the true worth of the underlying business based on its ability to generate profits over time. Sometimes the market prices a great business below its real value. Sometimes it prices a weak business far above what it's worth. That's where opportunities and mistakes are created. Think of buying part of a local business. If someone offered you 10% of a successful laundromat, you wouldn't ask what someone else paid for it yesterday. You'd ask how much money it earns, whether profits are growing, and what a fair price would be. Stocks should be viewed exactly the same way. Their ownership in real businesses. This explains why Buffett stays calm when prices fall. If the business itself hasn't changed, a lower price doesn't automatically mean a worse investment. Sometimes it simply means the business is available at a discount. Henry, however, only watches prices. He knows the exact value of his portfolio every day, but he has no idea what any of the businesses inside it are actually worth. He has been staring at price tags while ignoring what's inside the package. Price reflects today's emotions. Value reflects what you actually own. One of the biggest mistakes investors make feels completely responsible. A stock rises 50%. They decide it's time to lock in profits. It sounds sensible, but sometimes they're cutting off years, or even decades, of future growth. Buffett's favorite holding period is famously simple: forever. As long as the business remains excellent, he sees no reason to sell. The stock market constantly transfers wealth from impatient investors to patient ones. Compounding is the reason. Most people imagine wealth grows steadily over time. It doesn't. Growth starts slowly, then accelerates dramatically. A $10,000 investment growing at 10% annually becomes roughly $174,000 after 30 years. Leave it invested for just 10 more years and it grows to around $452,000. More than half of the total wealth appears during the final decade. That's why selling early is so expensive. You spend years waiting for compounding to work, then walk away just before the biggest rewards arrive. Starting early matters for exactly the same reason. Someone who invests at 25 often finishes with nearly twice as much as someone who starts at 35. Even if both invest the same amount, time is the one advantage you can never recover once it disappears. Henry finally notices this. One of his investments gains 50%. For the first time, instead of rushing to sell, he simply holds it. It's a small decision, but it's also the first time he stops paying what we've been calling the genius tax. Buffett often seems to give 2 completely different pieces of advice about diversification. People usually quote whichever one supports their own opinion. In reality, both are correct. For investors who truly understand businesses, Buffett believes excessive diversification can reduce returns. If you found a few outstanding companies and understand them deeply, spreading your money across dozens of average businesses simply weakens your best ideas. That's how Buffett has managed Berkshire Hathaway for decades. At times, a single company represented a huge portion of his portfolio. But here's the part many people ignore. For the average investor, Buffett recommends something entirely different. He repeatedly says most people should simply buy a low-cost S&P 500 index fund and hold it for the long term. He's so confident in this advice that he included it in his own estate plan, directing that most of his wife's investments should go into a low-cost index fund. So which strategy is right? The answer depends on you. If you're capable of carefully analyzing businesses, concentration can make sense. If you're not, broad diversification through an inexpensive index fund is probably the smarter choice. Henry realizes he owns several companies he can't even explain. Instead of pretending he knows more than he does, he sells those positions and moves the money into an index fund. That's not giving up. It's matching his investment strategy to his actual knowledge. Humility is often a better investment than confidence. After hearing about market crashes, bubbles, and investment mistakes, many people reach the same conclusion. I'll just keep my money in cash. It feels safe, but Buffett has warned for decades that cash carries its own risk. Inflation quietly reduces its purchasing power every year. Back in 1977, Buffett described inflation as a hidden tax. Unlike market crashes, inflation doesn't make headlines every day. It slowly reduces what your money can buy. At an average inflation rate of 3%, a dollar loses nearly half its purchasing power over 20 years. Your account balance may still show $100, but that money buys far less than it once did. During periods of higher inflation, like 2022, the damage becomes even greater. Cash certainly has a purpose. Emergency savings should remain easily accessible. That's smart financial planning. The mistake is keeping long-term investment money in cash simply because markets feel uncomfortable. Money intended for 10, 20, or 30 years from now needs the opportunity to grow faster than inflation. Throughout history, productive assets like businesses and stocks have done exactly that. Henry also develops another bad habit. He checks his investment account constantly. Every temporary decline makes him anxious. That anxiety pushes him toward emotional decisions, bringing him right back to the earlier mistakes. Sometimes the smartest action isn't doing more. It's simply checking less. Let's review the 12 mistakes. Trying to time the market, paying high fees, letting emotions drive decisions, investing outside your circle of competence, anchoring to your purchase price, following the crowd, using leverage, confusing price with value, selling winners too early, getting diversification wrong, hiding in cash. Notice what's missing from that list. There's nothing about having a high IQ, nothing about being a mathematical genius. The investors who nearly collapsed the financial system were among the smartest economists in history. Their intelligence wasn't enough. Every mistake we've covered is simply another version of the same problem. Trying to outsmart the market instead of outlasting it. Charlie Munger captured the lesson perfectly. It's remarkable how much long-term advantage people have gained by trying to be consistently not stupid instead of trying to be very intelligent. By the end of our story, Henry isn't smarter. He simply becomes more patient. He stops selling great businesses too soon. He replaces guesses with sensible investments. He keeps enough cash for emergencies while allowing the rest of his money to grow. Most importantly, he stops fighting the market. That's exactly what made Warren Buffett successful. He didn't become wealthy by making brilliant predictions every day. He became wealthy by avoiding ordinary mistakes, staying patient, and allowing time to do the heavy lifting. Sometimes the most profitable strategy isn't exciting at all. Sometimes it's simply buying great businesses, holding them for years, and, like Buffett, taking the occasional nap. Thank you for watching, and I'll see you in the next video.